Okay, thanks. Welcome. We'll reconvene our pension board meeting separately. I'm Eric Henlon, so we'll call this meeting to order. And first, before we get to the agenda, I do want to welcome Rebecca Harlow to our board. And as Mitch indicated, Rebecca got about 5 years worth of information in the last about hour and a half. So welcome, Rebecca, and please feel free to ask all the questions
Great.
and get up to speed on things.
Thanks.
So we'll get to our separate agenda. So the first is our version of public participation. We haven't been notified by anybody, and I don't see that we have any guests, so we'll skip over that. Next item that we do have is in your packet was the draft board minutes from our last meeting of February the 18th. Hopefully everybody had a chance to review those, and I would entertain a motion to approve those minutes.
Motion to approve.
Second.
Any comments or corrections? If none, all in favor? Aye.
Aye.
Any opposed? None. Thank you. So our board minutes are approved. I had, for both Chris and Michelle, I know you've given a lot of detail, so we're not going to go through and start all over again. So Chris, we'll go to you first. Give Michelle still a break to catch up from her talk. Get that drink of water that she wanted. So Chris, I'll turn it over to you as to what you want to go to and add in from your previous presentation.
Yeah, thanks, Eric, and good evening again, folks. You know what? I'm going to just out of habit, I suppose. Bear with me here. We're not going to reproduce all this, but maybe just a couple of highlights for the pension board and just a touch deeper of a dive. So we did have, thanks Eric for that save on the fees. I was scrambling to try to pull up my other screen here, but just from a governance perspective for the board, right, kind of our once per year dive into fees, just so we've really, earmarked what those fees are and kind of acknowledged them. I think, again, call it 60 basis points, kind of all in for, the investment centric stuff, if you will, that the portfolio is, bearing a reasonable expense load and is, similar for other plans we deal with in terms of complexity and allocation and whatnot. As we all know, right, we drive solutions to the cheapest funds where we're deciding to take active management and we're mixing in some indexing. And again, I think inside a 0.5 or 1% is a reasonable expense. And moreover, as we just saw, right, we have consistently seen the managers net of those fees be able to add a bit of incremental return through time. So I think we're in pretty good working order from a fee standpoint. Again, I don't think there's an action item for the board this evening other than just a collective acknowledgement that we've looked at fees and accounted for them, if you will.
Chris,
Any thought?
Chris, yeah, it's Mitch.
Sure, Mitch.
The comment was made at the last meeting about our total fees being about 130,000 based on that, and yet I'm seeing at the very bottom of this fiducians fees were 24,000 last year. Can you take me through where there's a
I think you've got to add everything together, right, Mitch? So the big load here, the investment managers, right? So
Right.
if we're 24 at 10, right? They're almost 5 times that, right? Based on the
Okay.
March balance, right? The vast majority of the fee comes out of the investment managers.
Okay.
So I don't remember the exact math that PJ was comparing to, but if you do the arithmetic, right, you're getting to a number that's, what is it, 100? We could take 60 basis points on 28 million, right? Eric is the accountant, and you do the math on that. It's obviously a big number than just our fee alone.
And I think, to the point of what PJ was looking at, if you look at as example, the Vanguard Extended Market Index, the fee is 6 basis points. Whereas the American Beacon Large Cap Value is 63 basis points. So, yes, they're both mutual funds. Question would be, why are we paying 10 times more for the American Beacon than the Vanguard Market Index? Well, the index is a passive, their costs are going to be lower. What we're looking for is for American Beacon to provide, as Chris always says, more, they're adding more value than just what the index will return for us by at least that differential of 57 basis points. And we're shooting for more than that.
Thank you. Both of you.
So we'll come back to that certainly once a year anyways, and recatalog all of that information just so you've got it handy and have a sense of it. We did obviously spend a decent amount of time, or at least a bit of time, so I'm not going to dwell here, but just to play on the idea, right? We've seen some great numbers in the markets. They are all predicated, as we know, on the world starting to open up and growth to be much more consistent around the world. And the upper right-hand corner of the page here, certainly on a forecasted basis here, it's pretty universal that you do see, this expectation that the world is going to start to recover, and markets with their discounting features, advance in front of that, in front of those actual, higher numbers, if you will, economically. I think we talked about performance in the other meeting and kind of a mixed bag for Q1 with rates higher. Rates have actually come down just a touch in the second quarter to date. So, and fixed income returns have been a little bit better, and equities, have done a little bit mixed here more recently, particularly last week, which was a bit of a difficult week for equities. And again, this idea, right, that we're not going to have, the pandemic was unprecedented in terms of the disruption economically, and to expect that we're just going to have this perfectly stepwise path to recovery with kind of no bumps along the way is not really a very pragmatic view, right? So when we see these pauses and whatnot periodically, the market's kind of functioning the way they should be, right? And kind of catching their breath periodically, hopefully on that path to more sustained growth toward the end of the year. Rates were higher, but still pretty darn low, right, from a broader historical context. So again, we talked about this, I think, in the earlier meeting. We won't belabor it. It does speak to, we've got close to 40% of the portfolio in an area of the market where the 10-year treasury March was 174. You see there, actually, as of the end of the day today, I think it was about 164. And that is a guidepost on a go forward basis, right, for what we're going to get likely from that portion of the portfolio. Although rates have moved a touch higher, they're still very darn low. So again, just something to be mindful of through time as we navigate through this transition, hopefully, to the new regime. We talk all the time, right, staying diversified globally on the equity front, right? U.S. markets have done particularly well, as we know, for an extended period of time, and their valuations reflect that, right? So we're looking here at ratios, price earning ratios, and kind of versus history and end of 2019 and where they reside currently. And lo and behold, right, when you look at U.S. equities, they've done better, but they're more expensive. And you folks have always been great about keeping that diversified profile in equity globally. And we think that makes perfect sense given the circumstances, and that the valuations being somewhat lower overseas is a beneficial tailwind perhaps. And then moreover, really under the covers here, but important, when you look at the complexion of international markets and kind of where their centers of activity are, they're in a lot of these cyclical areas like financials and industrials and those kind of things that typically do very well early in economic cycles. So if you buy into this notion like we do that we're going to get this advancing economy in the back half of this year and into 2022, international equities have a couple of attributes in their favor, we would think, both from a valuation and a complexion front, to maybe catch up a little bit to their US counterparts. So something that we'll be watching for you as well in the coming quarters. I think we looked at performance and allocation already. Just as mentioned at the last meeting, we did work with Mitch. We did raise just about $500,000 at the end of April. All of that money came from equity, the equity overweight positions, and was put back into short-term liquidity to draw down over the next few months. And we'll continue, right, to press on those overweight areas of the portfolio as need be, when we're raising capital for pension obligations.
And then Chris, just to also remind everybody, come July, when the town makes the pension contribution, and they usually make the pension contribution end of July, beginning of August, based upon what our liquidity and excess funds, if we have excess funds at that point from the contribution, we'll look to invest in the areas where we're underweighted. So that's the other half of kind of the rebalancing that gets done.
It's a good reminder, Mitch. Absolutely. Good point. We do have the entire roster on maintain. I know for the board, that's of particular interest. I didn't mention that with the Board of Finance, but we do have for your records, everything is in good working order. All of that work product is detailed, as you know, deeper in the book. But we don't have any status items to elevate to the board's attention this evening. I think we're in pretty good working order. It was interesting, just under the hood here, and then I'll stop, I promise. We talked about it being kind of a difficult quarter for fixed income. MetWest and Western are the anchor managers, as you know. Western is slightly more aggressively postured, right? So no surprise that in a quarter where there were headwinds for fixed income, they struggled a little bit more than MetWest, right? These managers are differentiated, but are kind of fishing in the same pond, if you will. It is interesting, right, when you look longer term, the way they kind of complement one another. To me, the biggest affirmation in the portfolio last quarter was BlackRock, right? Remember what we did there? We added them to be kind of a defensive animal, if you will, in periods of stressed interest rate environments. We had that to an extent in Q1. Nothing you're going to do cartwheels over in terms of returns, right? But a positive return nonetheless in an environment that was difficult. Doing exactly what we would hope they would do is kind of a complement to Western and MetWest, and where they're investing. Nothing else really jumped out at me in terms of the balance of the portfolio. Harbor Capital and some of the rotation away from the tech names in the quarter, you see, had a little bit of a difficult Q1. But again, right, like we always say, it has not really risen to the level of concern given their longer term track record just yet anyways. And then Euro-Pacific growth as well. Had some positioning in some emerging markets in particular that was difficult for them. So not by any record, not a good quarter for them, right? But again, on the heels of a pretty solid 1 year, even with the difficult Q1 of this year, and then an exemplary track record longer term, right, versus their peers and benchmarks. So nothing there in either of these two circumstances, Harbor nor Europac, that really raises up to a level of, we think, actionable items, if you will, or consideration for the board. And I think with that, Mr. Chairman, given the amount of time we've discussed this already, I will stop with my prepared comments, see if there's any other questions, and if not, I'll cede to you on where we go next. Did I miss anything?
I'll open up to the board if there's any questions.
I'm good.
None from me.
I just have one quick one, Chris, because I know the hour is getting late. You talked a little bit about, the Fed inflation and you know, that some of this looks to be more, you know, just kind of this getting the economy restarted. But what is it that your group looks for, and what would you come back to us for in terms of potentially rebalancing the portfolio of a longer term higher inflation rate?
Yeah, so right, if you look at the portfolio, right, Eric, where we're gonna, you know, bear with me here, right? Inflation is not gonna be a friend for fixed income, probably, all things considered, right? But again, inflation, and you think about it, kind of a corollary is likely higher interest rates. That's why we've got BlackRock right in the program, and they'll do better in that environment. That's why Brandywine, with a focus on global markets and non-US interest rate exposure, should help out a little bit over time. So I think we've got, just on the margin here, a kind of an answer within fixed income. Inflation for equities, right, usually is not problematic, because equities generally are a pretty good hedge against inflation, right? When we're getting inflation, it means economies are heating up more often than not. And that, you know, should be tailwind for equities. So I don't think we have any issues there. REITs as well, right, have an element of inflation protection, right? You're under the hood, right? A lot of these properties are re-upping with tenants at higher renewals in terms of lease rates and whatnot. So we've got some protection there. And then, of course, tips too will do well in a period of unexpected inflation. I think we're in pretty good working order in the portfolios. Just looking at this here, bear with me. I wanted to, and I'm hoping I didn't lose my connection to the network. Am I conflating something? Did we not talk as a group about adding diversified real assets to the portfolio? Didn't we talk about that, or am I conflating that with another client? I'm embarrassed to say.
We previously had some commodity funds, and you know, and I think I was probably the one over a multi-year period that just kept saying, "Why are we in this with no inflation?" So maybe I'm now going to be proved wrong. But
I'm just looking
no,
here.
I don't think we talked about that at the last meeting.
I think we decided that the TIPS fund was sort of a more stable hedge without the volatility, and decided to consolidate what had been in the commodities into the TIPS.
And
I think I'm conflating, Barbara. I think both of you are absolutely right. It's my fault. At 9:10 at night,
it's
I
okay.
have lots of funds that are demographically very similar to a town of Orange, Avon, Simsbury, Glastonbury. They kind of roll off here one after the other. But you're right. So I think we're in good working order is where I'd leave it in terms of allocation in our manager profile right now. We share, Eric, I think the Fed's sentiment that the inflation we're seeing that's popping a little higher is likely transitory, right? And that supply chains and whatnot will begin to recalibrate and things will settle down a little bit, even if we have a bit of a spike here. So I think we're positioned okay, even for a little bit of a touch of elevated inflation. If it becomes more problematic or enduring, we'll obviously be back to you in front of that with some thoughts if need be.
Okay, thank you.
Actually, I have one quick question. Are any of these managers particularly exposed if the new administration has a lot of success moving away from hydrocarbons and into green energy?
Yeah, I would say, or that's an interesting question. I'll tell you that actually it's been a very big focus of our research team over the last couple of months. Most of the managers now, when you talk to them, are beginning to actively integrate ESG considerations into some of their screening and portfolio construction processes. So a lot of them, I think, have really, as an industry, have bought into this idea of kind of, you know, green, if you will, and of being kind of good citizens, if you will. So I think there is an element of protection across the portfolio because all of the managers that we survey are to some form or fashion or degree kind of following some of those footprints. So I don't think there's anyone particularly highly exposed. You know, the index, right? The Vanguard index doesn't know that, right? It can't take active bets against that. So it does own some of the large integrated oil companies and other type of things, right? That I guess on the margin could suffer a bit, but I don't think it's of a magnitude that we need to take action just yet on. So I think we're in okay position on that front.
Thank you.
Okay, any other questions for Chris? If not, next on our agenda, and Michelle, I'm not going to ask you to redo your presentation. You did a great job. Thank you very much. But I figure I'll really just leave it to the board to, if there were any questions or anything you wanted to, that anybody wanted to follow up with Michelle on for this portion of the meeting. And because then typically a lot of this information we would go over at our August meeting, so we're not going to redo that in August, but I do appreciate you getting this earlier for us for this meeting, Michelle.
I did want to talk through two different things though that
Sure.
they wouldn't care as much about, but I wanted to draw your attention to. When the town got down to 10 years, we said, okay, we're going to switch over to layered amortizations because you don't want to get down into the 5 and 3 year amortization period. It's just way too volatile. And we said, the police isn't there yet. It will be in a couple of years. Well, we've hit it with the police now that in January 1, 2021, it is now at a 10-year amortization period. So I can't recall if for the town plan, there was a specific motion made or if that motion wasn't made until it actually was the next year. So I don't know if this is something we need for 2022, but I'm assuming that for the police plan, you're going to move to layered amortization basis, just like you did for the town plan.
I would assume so, for the exact same reason that you start taking the unfunded and you divide by such small numbers, you have the potential to end up with these huge swings from one year to the next, which would not be good from a budgetary standpoint.
And it's very manageable and defensible too, to be able to say like, okay, we are now saying 10 years and here's when it will be paid off. All right, we had a new thing happen that year and now that will be paid off over 10 years. I like the layering of bases because you can really see what's happening and see that endpoint of, yes, it will be paid off. Ta-da.
Yeah, I don't recall if that was something that we did for the town. I think we did it in the year it occurred, not the year before. So I think we're probably good now, unless
Preview.
unless somebody wants to jump the gun here.
And then the other thing that we talked about on the town side that could come up potentially in the future is that when we do these 10-year layered amortization bases, it's possible that you will have a gain one year. And that's what happened. We have a gain this year. And so at the time when we developed the layered amortizations, we said, okay, in the future, we will look at what do we do if there's a gain? And since this is the first year it's happening, I thought we should discuss it. And there are two main potential options that I would propose. Option one is just create a new base. That's what you would have done if it was a loss. You'll just amortize it over 10 years and we will move on about our business and just have a nice little chunk line added here next year. That is a tiny $83,000 gain, amortized over 10 years for $9,000 a year, and you'll just recognize it over 10 years. That's an easy solution. Do exactly what we've been doing. Option two, and this in my mind is kind of what you would do in a corporate accounting world, is if you had a new base that you were establishing and a new gain base and you had these outstanding loss bases, you'd go back and take your oldest loss base and offset it, reduce it by this little gain base. You wouldn't create a new gain base. You would just say, okay, I'm going to just wipe out a little bit of my old loss base. And so effectively, instead of recognizing the 83,000 over 10 years, you're effectively recognizing it over 7 years. And since we're talking about really small numbers, I mean, 83,000 goes down to 9,000. It's not a huge impact this year, but you're basically establishing the precedent for what we're going to do in future years if there's future year gains. If we were to apply it against the 2018 base, then the new 2018 amortization, instead of being 322, would be 310. And so your total past service cost, instead of 509, would be 506. So we're talking about clearly huge numbers here, but I wanted to give you the opportunity to say, this is the way we would like to address this.
Michelle, before we address that, if you don't mind, the numbers you're presenting tonight, and Eric said, you know, you usually see things in August. Are the numbers we're seeing tonight what we would normally see in August, or are we still going to see different numbers in August?
These are the August numbers. There are no other numbers.
So does that mean, just so I can get my head around this, that the budget that we have not yet passed, which goes to vote on Thursday, for the 21-22 fiscal year, you're already showing us the ADC for a year from now?
Yes.
Correct.
Guess I wasn't quite aware of all that. And what you're also showing us then is that am I correct that in both the police and the town side that are actually determined contribution would actually decrease in both sides?
Not relative to the transition amount, to the phase-in amount, but overall, yes, they did decrease.
Okay. And so with that, so yeah, that was the phase-in we did over 2 years. Am I right? Or was that something different?
Yes, it was, you went 50% of the way.
Right, last year.
Yep.
Okay. And by doing the 50% this year, so the number you're showing us it counts for that, correct?
Correct. There's no phase-in whatsoever. We're just at the final number.
Okay. All right. And so with all that, you're also not recommending we go from 6.25 to 6.0.
I don't think that you need to, because yes, we were looking at the 5.9, and so that's lower. But like Chris showed in his presentation, you've been generally earning at least 30 bips long term over what the benchmarks would be. So I think that's fully supports a 6.25% rate of return.
Just for benchmark or landmarks here, Guilford did move to 6.0 this year, where I also am involved. And we were hoping that the 6.0 would be the end of the game. I'm surprised you're saying 6.25 is good to stay, but if you think it is and we can have some good numbers next year, then that's all good news, relatively speaking. So getting back to your original question, I would say continue doing what we've always done, which would be plan A, would be my recommendation.
We haven't had this in the past, Mitch. So there isn't anything that we've done in the.
No, but you said using the same concept as if when things go up or down, the opposite. Am I right in understanding that?
Right. It's treating a gain the same as a loss.
Right.
Yeah.
And that was your first option, correct?
Correct. Mm-hmm.
And I would agree with doing that for just consistency basis, but unless somebody can talk me out of it, I think that's the way we should go. How anybody else feels.
I'm fine with it.
The accountant in me says you apply as much gain as you defer your loss and you recognize all your gain as quickly as possible. But that's accounting. So,
And that's why I use the counting as the example of how to do it.
I take the opposite view, but I mean, the numbers that we have, relatively speaking, the numbers that we have and any numbers that we're going to have from changes are so small. I don't think it's effectively going to make that much of a difference.
I just think it's more defensible in the municipal sector where everything's very public and very transparent. that we treat the gains and losses the same way.
Sure.
That-
Yeah, I'm comfortable either way. I mean, it's not enough to swing it one way or the other.
Right.
Now, on the other hand, for the police plan, we could end up with a more material number and a more material gain in a year. But you know, I can live with what it is. I mean, given the age of the plans and how many years, you know, that we've got, and the small number of actives that we have in both plans, I could live with it.
Then
Do we
no
need a
changes.
formal vote on that?
We probably should, just to document it and get it ratified. So, you know, I mean, with that, and I don't know, we didn't have a vote on the agenda, so would we need to table this till the next meeting just to add it to the agenda?
What's part of the agenda is part of the Millman report, no?
Well, it just says, we just have actuarial review, but typically if there's going to be a vote on a change on something, we make sure that's on the agenda. So
Let's do that then.
why don't we table this and we'll add it to the agenda for the August meeting. Michelle, you're not required to be there if there's nothing else, but then that way we can get on the agenda, make sure that there's no issues with it.
If you'd like to see what 6% would be, I could put together a one-page thing so you could look at the 6% numbers.
I wouldn't
Just
mind.
One stable year might be nice.
I wouldn't mind seeing them, especially if it is a stable year. It may be a
Yeah.
year we're able to make that move, you know, and then if something goes wrong the following years, we're in much better position. I know, as was said earlier, that we're very conservative, but in this realm of things. But I guess I'd like to see that. And also, Michelle, just for clarification, once again, the A versus B, or the options we're discussing, what you showed the Board of Finance tonight for the actuarial determined contribution would have been based on the first option?
Correct.
All right.
Correct. Which in the end is a modestly higher contribution than if you were to make the change. So it was the high end unless you change the 6% to a 6% discount rate.
No, I understand that. Okay.
Yeah, it's about a $3,000 difference. So, okay, so why don't we table this? Yes, Michelle. I think that it probably would be good to see where we end up at 6%, if for nothing else, just the academic exercise to understand the magnitude of it. And then we can consider that for the August meeting. So.
Sounds like a plan.
Okay. So if there's any other questions, comments? Rebecca, you're with us? You're still with us? We haven't
I'm
lost
still
you?
here.
Good. So then,
Rebecca, let me just add, Eric. Rebecca, if you have any questions at all, and I'm sure you may, we don't meet that often,
Yeah.
but anybody on this call, and that would include John Cifarelli, who's the finance director, we would all be more than happy to help explain any questions you have. Eric's chairman, he's very well versed in all this, and John Cifarelli, the two of them especially, but I think Barbara, myself, Audrey, Michelle, Chris would all be willing to answer any questions you have, bring you up to speed.
Oh, that's great. Thank you.
absolutely.
Barbara actually filled me in the other day on some things, so that was nice.
Barbara.
Thank you, Barbara.
I hang out at the library. What can I
Ah,
So our next meeting is scheduled for August. Let me get my calendar in front of me. August the 19th, I believe.
Yep. That's right, show.
And who knows, maybe we'll be back live with a live meeting by August, the way things are going.
Oh, I certainly expect we will.
Um,
I'm optimistic.
But if nothing else, I would entertain a motion to adjourn. And by the way, I thank everybody, especially Chris and Michelle, for your presentations and bearing with us for this long evening tonight. So, but with that, I'd entertain a motion to adjourn.
Motion to adjourn?
Second,
Second,
second.
all in favor? Aye.
Aye.
Great. Thank you very much. Have a great evening, and we'll see everybody in August.
Thank you.
Thank
Bye,
you.
folks.
Right.
Yeah,
Thanks.
Take care.